Hello, traders. Good morning, good afternoon, and good evening to wherever you are watching today. So, before we begin, please let me know if you can hear me well. So, if you can hear me well, please type 1 on our live chat box. All right. So, thanks for confirming that you can hear me. You can hear me well. So, good evening, Leonito Loma. Good evening din po, sir. So, by the way, may I ask if you already opened an account with us? So, did you open an account with us? If not, there's still time to open one because after this webinar, there's a task or an activity that you can join for you to be able to have a chance to win the $100. Hello, home sweet home. It's nice to see you again. How are you doing, sir? Thanks for confirming that you already have an account, Sir Lito Mateo, as well as Leonito Loma. All right. So before we begin, please let me know your name and where you are watching today, so that I can greet you. Hello, Ramel Uy from Malabon City. That's okay, Lito Mateo. Every beginner traders experience burning their account once. I also experienced the same. Good evening to you as well, Sir Lito, from Tublay, Benguet. Hello to you as well, Sir Romel Uy. Hello, Shailendra at 99. So we will announce the winner from our first task on our Telegram channel. So if you are not yet joining the Telegram channel, you may see the link on the description box below for you to be able to join, of course. Good afternoon to you as well, Sir I Window. As well, Sir I. All right, so I think we can start right now. So before begin, I would like to discuss this just real quick. Okay, so again, the benefit or the participants can get a benefit which is 100% deposit, 100% deposit bonus for their live trading account. So we will share the promo code again at the end of each lesson. Okay, and you will also have a chance to have a certificate of attendance after finishing this entire webinar series. So again, this is four part, or we have um, 4 webinar series in this whole workshop. So last Wednesday, we conducted our first webinar and today is the second. So on next Wednesday, we will have our third webinar, and then on May 5, we will have our last webinar. So I hope to see you all up to May 5 for you to have this certificate of attendance with us. And of course, the $100 giveaway. So again, I would like to invite you, I would like to invite every one of you to please join us on our Telegram channel for you to be able to join the tasks that which will be given from each lesson after every webinar. Everyone is free to join. And then of course, you will also get the guidebook in PDF format each webinar, after each webinar. So last time we didn't give the copy of the PDF yet, so we will give it later. All right. So again, if you are brand new to my webinar, again, this is Paul Mendoza, your trading speaker. I've been trading for 6 years. So this is just a mistake. I've been trading for 6 years now. So I just like what Sir Lito said earlier, I also experienced burning my account when I am just started or when I am just starting. But after that, I gained a consistent approach, or I gained consistency in my trading. And just like what I said last Wednesday, I experienced assisting a startup trading desk, handling the funds of my private investors, and I am also working as a full-time trading analyst for one of my clients. Okay, so enough of me. So what we are going to discuss for today is the first is the advantages of the Forex market. So we will see, or we will discuss, or we will learn what Forex market is all about and the some of its advantages. If you are trading stock, of course, there's also a good thing in the stock market, but Forex market is a whole different market, and there's a lot of advantages in Forex market than the stock market. But I am not saying the stock market is bad. All I'm trying to say is there's an advantage, is the disadvantage for every market out there. And we will also discuss about trading sessions. What is the best time to trade? Is it good a good time to trade at noon, at the evening? Of course, we are talking about our time zone here in the Philippines, as well as when is the best time to trade Forex. Later, we will discuss the London session, New York session, and uh, Tokyo and Sydney session. And we will also discuss the London breakout strategy. We will also talk about Forex terminologies, leverage, take profit, and stop loss. All right, so to begin, some of the advantages of the Forex market is high liquidity. So this one is very, very important because, for example, we are seeing that the price is on an uptrend. So let's say that you want to buy once the price reach a certain level of support right here. So because of high liquidity, your order will automatically be filled. So once the price reach your desired level of support, so let's say the price reach this level, so let's say it is sitting at around $2. So because of high liquidity, once you click the buy button, your order will be automatically executed, and you won't have the problem of some slippage or some delays on your buy trade. Unlike here in the Philippines, in our local stock exchange, so let's say the price is pulling back. So let's say you want to buy a certain amount of stock, and you want to buy 5 pesos. So let's say for each and every share, it will cost you 5 peso per share. But because Philippine stock market has only low liquidity, or the liquidity in our local stock exchange is low, you need to wait. I think it will need you to wait up to certain minutes. I'm not sure, but the bad thing about it is, let's say you want to buy at 5 pesos, the price went up to 8, and then someone sold their shares to you, then your order will only be filled at 8 pesos. So imagine having a spread of 3 pips or 3 points in this case. So 3 points is very, very huge in trading, right? So this is the beauty of Forex market, the beauty of the Forex market. It has high liquidity into it. So you won't have this kind of problem, whether you want to buy at $2, whether you want to buy at $3, it will automatically be executed. And of course, let's say you want to take your profit. So let's say the price goes up and you want to take your profit from this previous high. So let's say it is sitting on $8. So after buying on the $2 right here, so let's say you want to take your profit at $8. So that's around 6 pips. Because of high liquidity, your take profit level will automatically be executed, or I mean, your trade will automatically be closed. You will enjoy the liquidity, high liquidity, because in other markets, so let's say the price already goes up on your take profit level, but if the liquidity is low, again you need to wait further before your trade could be executed. So imagine seeing the price action bouncing off around your take profit level, and then the price goes down. So because of low liquidity, your TP couldn't be closed right away. So that's the sad thing, or the bad thing, if you are trading on a low liquidity market. But in the Forex market, you will never have this problem because of high liquidity. Again, because of this, your order will automatically be executed. So if you want to buy at $2, if you want to buy at $3, no problem. You won't experience any problem with that. And if you want to take profit, just put your take profit level. So let's say you bought here and you set your TP here. Once the price reach your target level, your target profit level, your trade will automatically be closed, or the trade, your winner will automatically be added onto your account. Okay, so that's the beauty of the Forex market. And then time flexibility. So we all know that the Forex market is open 24 hours in a day. So because of that, we can be flexible. We can trade at noon, we can trade at night, we can trade at daytime. If you are working a 9 to 5 job, so of course you won't be able to trade on your office. So because of that, you can trade at night after once you arrive at home, you can trade at night. Or if you are at night shift, you can trade on daytime. So because of time flexibility, Forex traders can enjoy trading anytime. And of course, you can also trade anywhere. And of course, the volatility. So this is also very, very important in trading. We all know that traders want volatility, right? Because once we saw that the price is moving, then we can participate in this movement. But if the price is going out of nowhere, or if the price is just consolidating, or if the price isn't moving at all, then there's a low volatility, or there's no volatility at all in that market. But in the Forex market, we won't experience this one, because Forex market is very, very volatile. So what I'm trying to say is, let's say you bought, let's say the price breaks this resistance level, and then you bought, let's say $4. So because the Forex market is very volatile, you may see the price action going up immediately just after buying. So if you want to scalp, or if you want to day trade, volatility is very, very crucial and very, very important in your trading. Because if the price, or if the market has a low liquidity, then you will find it difficult to scalp or to day trade, because the price won't move at all. But because the Forex market again is very, very volatile, you may see the price going up immediately just after buying. So in my experience, I am only holding my trades, especially if I am day trading. I can only trade 5 to 30 minutes a day. So let me show you an example. So my recent trade here, as we can see here, was the Aussie yen. So it is just last April 20. So I won $1,597. So by the way, this is just a demo account. Okay. So if I'm not mistaken, I just held this trade for about, if I remember it correctly, I only held it 5 to 10 minutes, I guess. So let's try to go back into this trade just for us to see the result of it. So here, so as you can see, I have this blue arrow here. So this is where I bought. So after seeing that the price breaks this resistance, then I waited for the pullback. Then I identified a support level here. Then after seeing a support level, I saw this bullish pin bar, this green candle right here. Then after seeing this, I put my order, or my buy order, into this green candle. And then as you can see, I just put my TP from the previous high. Then as you can see, because the Forex market is very, 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 very volatile, I only held my trade in just about 5 to 10 minutes. So this is the beauty of the Forex market. So as you can see, this is a 5-minute chart. So after buying into this candle, the price immediately goes up into my favor. And then I only held my trade at about 10 minutes. So this is the beauty of the Forex market. So combining all of these things together. So we have high liquidity. So I didn't experience any lags or delays on my order. Then I can trade anytime. So as you can see here on this example, you can see that I traded this at around 12 midnight, 12:25 a.m. So because the time is very flexible, I can trade anytime, and then the volatility is very important because as we can see, I only held this trade at around 10 minutes. So after 10 minutes, I already hit my target. So this is the beauty of the Forex market. And then next thing is various tradable instruments. So we can trade major currencies, minor currencies. But again, if you are a beginner, just focus on the major currencies first. Okay, so we have a lot of choices, various tradable instruments. We can also trade the commodities. So let me just show you my watch list here. So as you can see, I am trading all of these pairs. So because the volatility is high, so we can trade various tradable instruments. So as you can see, I have some of my major pairs right here, right? I also have some minor pairs. So this is the beauty of the Forex market. You can choose whether you want to trade commodities, whether you want to trade major pairs, or whether you want to trade minor pairs. Okay, so it's totally up to you. And of course, zero or minimal commissions. So especially us in OctaFX, we are very proud to say that we don't charge commission. So just like what it says here, zero or minimal commission. So if we open a trade right now, so let me just show you what I mean. So let's say I want to open a trade on the dollar Canada. So if I buy right now, so you can see that we don't have commission right here, and we also don't have swap. So swap is the price, or the price that we need to pay for our broker if we are holding our trades overnight. But as you can see here on OctaFX, we don't charge swaps. And this is very important, especially if you are a swing trader, because swing traders are holding their trades at about 3 days to 1 week, right? So I remember holding my trades back when I am a swing trader. I tried swing trading. I held my trades at about 1 to 2 weeks. So imagine if you are paying swap, and it will cost you a lot. So here at OctaFX, we don't charge commissions. We don't even charge swap. So this is the beauty of the Forex market. So again, zero or minimal commissions. And then the leverage. So a lot of traders are very obsessed with leverage. So later we are going to discuss about this more. But keep in mind that leverage is a double-edged sword. It will give you a lot of money, and it will also cost you a lot of money if you use it wrong. Okay? So what I'm trying to say is, just because you can use a high leverage doesn't mean that you should use it. So just keep your risk intact, your risk management intact, because leverage is very good if you know what you're doing, because it can multiply your account. So let's say you only have $200 on your trading account, but because of high leverage, you can trade up to whatever percentage you want. So the golden rule in trading is to only risk 1% per trade, right? But because of high leverage, you can trade 2%. You can even trade 10% if you want. But this is not advisable. I don't recommend trading 10% per trade. But as we can see, this is very possible because of leverage, and a lot of traders are capitalizing on this. Okay, because we all know that if we don't use leverage, it will be hard or difficult for us to risk even 1% of our trading capital. But because of high leverage, then we can do it. And then the last thing is we can practice on demo accounts. So this is very, very good because I experience, just like what I said earlier, I experienced blowing my entire account in just 2 days back when I am starting. I don't know anything before, so that's why I lost my entire account. But because we have the benefit of practicing on a demo account, just like what we have here, so this is a demo account. So because we can practice here, then we can test our strategies and we can also be familiar with the platform, right? Because as we all know, it is very, very difficult to start in trading if you don't know what you are doing, right? But because we have the ability to trade on a demo account, then we will be able to trade on the platform and we can be familiar with the platform without risking any amount, right? So that's the beauty of the Forex market. So these are some of the advantages of the Forex market. Okay. So now we are going to talk about the trading session. So currencies are traded just like what I said earlier. It is traded 24 hours in a day, 5 days in a week around the world. Trading market opens Monday morning in Wellington, New Zealand, and it stays open till Friday night in New York, USA. So each trading day can be divided into 3 trading sessions depending on the financial center. The financial center active during a specific period of time. So the time each session opens and closes are it's based on the local business hours. So here as we can see, first the Sydney session will open at 10 p.m. So take note, this is GMT plus 1 time zone. So here in the Philippines, we are GMT plus 8, right? So this will open at around 5 a.m. if I'm not mistaken. 5 a.m. or 7 a.m. And then the Sydney session will close at 7 a.m. GMT plus 1. So 15 or 3 p.m. in Philippine time. Okay, so basically what I'm just trying to say here is if you want to trade the Sydney session or if you want to trade the Aussie pairs, then you may want to look for the Aussies or the Sydney session because Aussie pairs are active during this session. So again, GMT plus 1, it is 10 p.m. up to 7 a.m. And then if you want to open a trade on the JPY pairs or the Japanese yen pairs, then Tokyo session will be the good session for you or the ideal session for you. It will open at 1 a.m. up to 10 p.m. Again, GMT plus 1 time zone. Okay, so for example, you want to open a trade on the Aussie dollar. So if you want to trade Aussie dollar, then you may want to trade this pair between this session or between this time. Okay, once you trade Aussie pairs at 8 a.m., then the volatility will be much lower because Sydney session just ended and the Aussie pair is not that active or Aussie pair is no longer active, I mean, because it's already 8 a.m. and the Sydney session has stopped. Okay, so again, if you want to open a trade on the Aussie pairs, so for example, you want to trade on the Aussie Canada, you want to trade on the Aussie yen, then this session is the ideal session for you. So likewise, if you want to open a trade on the Euro session or on the Euro pairs, so let's say you want to trade the Euro dollar, then London session between 8 a.m. to 5 p.m. is the ideal session for you. Okay? And if you want to open a trade on the pound pairs, London session is also the ideal session for you. Okay, so if you want to open a trade on pound yen, pound dollar, pound Canada, so this session is the perfect opportunity for us to trade these pairs. And of course, in the New York session, it is a very, very good session for us to open a trade on the dollar pairs. So if you want to open a trade on the dollar Swiss, dollar yen, or dollar Canada, so this session is the ideal time for you to open a trade on the dollar pairs. And we also have um, some intersections. So let me show it to you. So here, as we can see, Sydney session will open again at 5 a.m. So this is now Philippine time. So 5 a.m. up to 2 p.m. So this is the Sydney session, the whole Sydney session. And as we can see here, we have some crossover or intersection on the Tokyo session. So it will start at 7 and then it will end at around 2. Okay, so this session right here is a very, very good opportunity for us to look for the Aussie yen, because both Aussie pairs and Japanese yen pairs are very, very active, and the volatility is very, very high between these sessions, because most traders are active, or these pairs are active during this session. Okay, but as we can see, Sydney and Tokyo session isn't that an ideal time for us traders to trade, because as we can see, there's only a light green indicator here. So what this means is that there's only a few participants in the market. Unlike here on the London session, we can clearly see that we have a thicker green indicator right here. So what this means is that there's a high volume, or there's a lot of market participants who are active in this session. So again, if you want to trade euro and pound pairs, so the London session is the perfect time for you. And as we can see, it will start at 3 up to 12. And we have crossover with the New York session between 8 p.m. up to 12 a.m. Okay, so in this session, this is the very, very high volatility market, or the volatility is through the roof in this time between 8 up to 12. Okay, so this is a very, very good opportunity for us to trade euro pairs, pound pairs, as well as the dollar pairs. Okay, so may I ask, what is your favorite pair to trade? So if you ask me, let me show you again the history of my demo account here on the trading view. As you can see, I am actively trading the Aussie pairs right here. So as you can see, I have both previous trades on the Aussie yen, both winners. And then here I have Aussie Canada, 3 Aussie Canadas. And then I lost on the Aussie Canada as well. And then I have a trade on pound pairs right here. So as you can see, I am actively trading Aussie pairs, right? And I know that, or I guess that you already know that my favorite pairs to trade is the Aussie pairs for some reason. So let me show you some of my history here. So as you can see, this is just a demo account. I am actively trading Aussie pairs on this demo account. I also have some pound pairs here, as well as euro. So as you can see, I am consistently winning on the Aussie pairs. As you can see here, every time I am trading pound pairs, I am constantly losing. So you can also incorporate this on your strategy. So if you saw that the pair that you are trading is giving you losses, then avoid trading that pair. Okay, so in my case, I am constantly losing on the pound pairs, but when I am trading Aussie pairs, I am constantly winning. So because of this, I decided to just focus on the Aussie pairs. Okay, so just a tip if you want to have a consistent result. So of course you just need to do consistent actions. Okay, so that's the importance of sessions. Again, if you want to open a trade on Aussie pairs, then Sydney session is the best time for you to trade. If you want to open a trade on the yen sessions or the yen pairs, Japanese yen pairs, then Tokyo session is the ideal time for you to open a trade. Then there's the high volatility market or high volatility session, which is the London session. And this is a good opportunity for us to open a trade on pound and euro pairs. And then for the dollar pairs, I know there are traders who are only trading dollar pairs. And this is the perfect time for us if we want to trade dollar pairs, which is the New York session. So take note of this because imagine trading euro or dollar pairs inside the session, then the volatility is lower. And we can also see that the market participants are low, unlike here. Okay. And of course, if you are trading on London session, then you shouldn't trade Japanese yen pairs here or Aussie pairs because they are not that active. You can still trade them, but of course, you should trade the most heavily traded pairs on this session rather than doing the reverse, right? Okay, and for our next slide, so as we can see here, we also have some keynotes or something to remember. So other than weekends, so again, on weekends, Forex market is closed. So there are just two public holidays when the Forex market is closed, which is Christmas and New Year's Day. Okay, so again, every weekends, Forex market is closed for us retail traders, as well as Christmas and New Year's Day. Also, opening and closing times are based on local business hours, with most business hours starting somewhere between 7 to 9 a.m. local time. So here in the Philippines, if you are trading at 6 a.m., you will experience the high spread. Most of the time, spread is going up to 10 pips per transaction. So imagine trading with such a high spread. It will be very, very difficult for you to be profitable because especially if you are a day trader, right? So this is happening between 6 a.m. if I'm not mistaken up to 7. Okay, so avoid trading 6 a.m. up to 7 Philippine time because the spreads are getting wider. Because as we can see here, opening and closing times are in this time right here in the Philippines. Okay, so I experienced before I traded at around 6:30 a.m. Then immediately after buying, the pair that I opened or the trade that I opened immediately hit my stop loss because of the spread. So avoid trading on this time between 6 up to 7 a.m. Okay, and the Forex market as well is opening and closing hours will change in March, April, October, and November. So countries move to daylight savings. Japan doesn't observe daylight savings. So pairs or any other pairs out there is moving to daylight savings. So in March, April, October, and November. But Japanese yen pairs isn't observing daylight savings. Okay, so take note of that. And it's very important to trade when at least 2 sessions are open because the market tends to be volatile at that time. So this is what we are discussing earlier. Okay, and for our next point. So here, now we are going to talk about the London breakout strategy. So this strategy is a popular strategy used by traders to identify potential trading opportunities during the opening of the London market session. So on London range, So this range established by the market before the London market opens. So it is the trading range of the Asian trading session. Support and resistance levels at this period are the key levels for setting buy stop and sell stop orders. So what I'm trying to say here is, for example, the price is moving like this, and then the Asian session is about to close. So let's say Asian session is about to close right here, and then the London session will open. So going back on our graphic earlier, so here as you can see, so this Tokyo session or this Asian session will close at around 3 p.m. and then at 3 p.m. Philippine time, London session will open. So in this case, we will see some volatility or some trading range, just like what we can see here. So let's say the price is doing this kind of price action, and then once London session started, or once the London session opened, we can identify some key levels of support and resistance right here. And then we can trade the breakout whether the price goes up or down. So let's say the price is on an uptrend, then we are anticipating a breakout at the top. Then we can put a buy stop order here. So by the way, stop orders is an anticipation of a breakout strategy, and the limit orders are anticipation of a pullback strategy. Okay, so if you are, or if you want to buy the breakout at the top, so again, this is a breakout at the bottom of the price action. So if you want to buy a breakout at the top of this price action, then you need to put a buy stop order here. But if you want to open a breakout at the bottom, so let's say you are anticipating a breakout of the support, then you need to open sell stop at this price level. So again, at the top, it is buy stop. Okay, and then at the bottom, you need to open sell stop order. Again, stop orders are the anticipation of a breakout, equals breakout. Okay, if you are anticipating a breakout, whether at the top or at the bottom, you need to put buy stop and sell stop order at the same time. So let me show you some real life example here. So here on the Aussie Canada, so here as you can see, I have this indicator, which is a trading session indicator. Here, sessions. So as you can see, I opened the London and New York session. So this green background right here is the London session. So as you can see, it is opening at around 3 p.m. and then it will close at around 8 p.m. Then this brown background here is the intersection or the crossover of London and New York session. Then this red background is the New York session. Okay, so to focus on the London session breakout, so here, let's say that we are just at the Asian session here. So this black background is the Asian session. Then once the Asian session close, we know that the Tokyo's or the London session is up next. So what we want to do is to put a support and a resistance at the of this range right here. So again, this London range. Okay, so remember this one. So this is what we can call the London range. So we have support and then resistance right here. So once the London session start, as we can see, the green background is now appearing right here. So that means that we are entering the London session. So we can put either, so let's just say we want to follow the trend. So the trend is down, right? So let's just say we want to follow the trend. So what we can do here is to put a buy or a sell order at the bottom of the support level. Okay, so let's say once the price reach my sell order, then my selling order or my short trade will be executed once the price breach this support. So in this case, we can see the price. So let's just say we want to put our sell stop at around 1 pip or 1.5 pips below the support, then that means once the price reach this level, then my sell stop order will be executed. Okay, then as we can see, the price reach this level, so that means my sell order will be executed with this breakout candle. And then our stop loss, of course, we need to put it above our previous high or our resistance level right here. So for this example, let's say we want to put our stop loss 1 to 2 pips above our resistance. So as you can see, we will put our stop loss here. So we almost lost this trade, but thankfully we can see that the price didn't quite reach our stop loss. Then as we can see, the price continued to go down. So for our take profit level, we can make the previous structure. So we have this previous low right here as our target. Okay. So again, after identifying the London range, right here, I put my sell stop order. Because we are on a downtrend, we want to follow the trend. I put my sell stop order. Or if you also want to, because again, this is range, so anything can happen. If you also want to put your buy stop order at the top, you may also do it. You can open both sell stop and buy stop order at the same time. Okay, so other traders are doing that move or that strategy as well. But in this example, we can see that the price reached our previous structure right here. So again, this is the previous low that we saw. And then we can put our take profit order right here. And then as we can see, the price reach our take profit before making this wild move right here. Okay, so that's how we can use the London breakout strategy. So let's try to look at some other examples. So here, this is a very good example. So we can see that the price is on an uptrend with this Tokyo session. And then once the London session began, we can see that it is now starting to form a range, or it is now starting to form a consolidation or a sideways move. So what we can do here is to put buy stop order and then sell stop order at the same time. So in this case, the sell stop order will be executed because we can see that the price breaks the support, right? So again, this is a range. The price decided to break the support level. Instead of continuing to go higher, the price decided to break this support. Then as we can see, if we put our buy stop or our sell stop order here, then our trade will be executed. Then again, we can put our stop loss just 1 to 2 pips above the swing high. So just like this, and then we can put our take profit level either from this previous structure. If you are a conservative trader, so this is the nearest previous low, or this is the nearest support. But if you are an aggressive trader, then you can put your TP right at the bottom. And then we can also see that the price also was able to reach this previous low down here. So in this case, we can see that if you are a conservative trader, then you will put your, most likely, you will put your TP in this previous low or this first support. So in this case, you will immediately took your profit. But if you are an aggressive trader, then you may put your target here. And as you can see, we also reach our target. And then if you are a very, very aggressive trader, then you can put your target from our third support, which is below here. As we can clearly see, once the price reached this support, the price started to go up. Okay, so this is the importance of looking at the support levels or the structure levels. Okay, and then for our final example, so we can see that again we have a range right here. So in this Tokyo session, we are moving down, but once the price entered the London session, so we saw this range right here. Okay, so we can put our sell stop and buy stop order at the same time. So in this case, the sell stop order will be executed because of this breakout candle. So we can put our stop loss just 1 to 2 pips above our swing high. So this is 7.4, so 2 pips will be 9.4. And then for our target, we can make this previous low as our target. And then as we can see, we also reach our target. But in this case, the risk to reward ratio isn't that good. So there's also a time to avoid trading this strategy if the risk to reward ratio isn't that good. Unlike this one, earlier, we can see that we can have a huge risk to reward ratio. And in this case, this is a good example. Okay, so we can see that it is always happening. So in this case, we have this range. And again, right here, we also have this range. Okay, so if you put sell stop here, then you may put your target just below this previous low. As we can see, we will win with this one. So this one is an example of a loss. As we can see, the price breaks the support, but after breaking the support, the price goes up. So this is an example of a loss. Again, there's no 100% in trading. Of course, we will lose from time to time. We will lose sometimes, but as we can see, this is a great opportunity for us to time the London session. So this one, we have another opportunity. So we have another range right here. So if you remember, this is also a Darvas box strategy, right? So again, this is a very, very good trade. So as you can see, if you put a buy stop order here, your buy stop will be executed. Your stop loss will be below the previous low. And then if you target this previous high, you will easily hit your target. But if you want to make this previous high right here as your target, and we can see that the price easily reached it. The price even went up to this previous high that we have right here, right? So that's how we can use London breakout strategy. Okay, so if you are learning so far, please type 1. If you have some questions, we will conduct a Q&A later. Okay, so let me show you how to open buy stop and sell stop order on our MT4. So for example, we are about to enter the London session. So in this case, we want to open buy stop and sell stop at the same time, right? So for us to do it, so just click new order here at the top. And then here at the market execution, just click pending order and then click buy stop if you want to buy, if you want to put a buy stop order, and then click sell stop if you want to open or to set up a sell stop order. So let's say, for example, we want to open a sell stop once the price reach this level because we are anticipating a continuation to the downside. Okay, so the price is 0.65658. Again, 65658. So we can put it right here. 65658. After putting your sell stop order, so you can click place, and then as you can see, we now have this pending order. So once the price goes down, and then once the price reach this sell stop order, the trade will automatically be executed for a sell trade. Okay? And likewise, if we want to open a buy stop, so again, just click pending order and then buy stop. So let's say we are anticipating a breakout at the top. So this is our resistance level, right? So let's say we want to buy once the price breaks this resistance. So we will put our buy stop at 66456. So let me just double check it. Okay, so 66456. So all you have to do is to put it right here. Then click place. And as we can see, we already have our buy stop order right here. So once the price goes up, like that, and then once the price reach our buy stop order, then the trade will automatically be executed. Okay, so that's how we can open buy and sell stop order from our MT4 platform. Okay, so if you want to put stop loss and take profit, so just double click this column, which is SL for stop loss and TP for take profit. So just double click it and then just put your stop loss right here. Okay, and then for your TP, just put it right here. Okay, so for example, here on this buy stop order, we want to put our stop loss at 65995. Then just click the SL button, and then just put 65995 on your stop loss. Then just click modify, and then as we can see, we already have our stop loss set right here. Okay, and if you want to put TP, so all we have to do is to define where we want to put our TP. So let's say we want to put it at this previous structure. So it is 66950. So just double click this one and then put 66950, then just click modify. And as we can see, we now have this buy stop order waiting for the price to reach our setup or our buy stop order. Okay, so the same is true if we want to put a stop loss and take profit for our sell stop order right here. Just double click this one, put your stop loss and your TP here, then just click modify. Okay, so moving on. So now we will discuss some terminologies which are very, very important in trading. So to go long means to buy. So if you heard your co-traders saying that take a long trade on the euro dollar, if you don't know what long means, then it will be difficult for you to talk to them, right? To talk with them. So that's why it's very, very important for us traders to be familiar with Forex terminologies. And to go short means to sell, to open a sell trade. Bullish market is an uptrend. It means that the market is going up. A bearish market means that the market is going down. So the reason behind this is because bulls are attacking using their horns, and then bearish or bears are attacking using their claws, right? So that's why it is called a bullish market when it is attacking on the upside, and then it is called a bear or a bearish market when the market is attacking us on the downside. It is like a bear using its claw to attack its prey, right? So bulls are buyers and bears are sellers. Then ranging market is just a sideways. So if the price is just going nowhere, just like this, so this is just a consolidation or a sideways. Then trending market, this is a market which is moving in a specific direction. Okay, so if your friend told you that euro dollar is trending up, then that means euro dollar is on uptrend. If your co-trader told you that the euro dollar is trending down, then that means the euro dollar is on a downtrend. Then hawkish, this is when the central banks is in support of raising the interest rates to fight inflation. This is good because when the central banks raise their interest rates, then it could be it could be that the price could go up, or it can lead to an uptrend. It can lead to uptrending market. But once the central bank decided to cut interest rates to favor economic growth, which is a dovish move, so this could lead into a downtrending market. Okay, and then for some currency nicknames, for the US dollar, it is called greenback. For pound, it is called cable. For New Zealand dollars, it is called kiwi. For Aussie dollar, for Australian dollar, it is just called Aussie. For Canadian dollar, loonie. And for oil, black gold. So for example, you want to trade, let's say, greenback against loonie. So what I'm trying to say then is USD against CAD, or dollar against Canada. If you want to trade cable against kiwi, so that means it is pound against New Zealand dollar. Okay, so something like that. So moving on. So now we are going to talk about lot size. So in Forex, lot size refers to the amount of currency units that are being bought or sold in a trade. So again, just like what we discussed last time, this is the deciding factor if you will win big or lose big. If you have so much or too much lot size in a single trade, then if you only have a small account, then it will cost you a lot. But if you win with that trade, then it will give you a big reward. Okay, so lot size is the deciding factor for your profit or your losses. So it is a standardized measure to help traders manage their risk and exposure in the market. So we need to know which lot size to open before opening a trade. So of course, we want to first look at the price action. So if the market is going up, and then if we want to buy, so we first need, we should be able to calculate our lot size before opening a buy trade. Okay, so this is very, very important. So there are three main lot size used in Forex. So for one standard lot, so one standard lot is equal to 100,000 units. For one mini lot, so this is 0.1 lot size. So this is an equivalent to 10,000 units. And then for one micro lot, which is 0.01 lot size, this is equivalent to 1,000 units. Okay, again, so for each and every one lot, it is equivalent to 100,000 units. Okay, so 100,000 units. For every mini lot or every 0.1 lot, it has an equivalent of 10,000 units. And then for one micro lot size, it has an equivalent of 1,000 units. So this is very important as well, because in TradingView, as we can see, this platform is using units instead of lot size. So let's say we want to open a sell trade. So this 1,000 units is equivalent to 0.01 lot size, right? But if I increase it to 10,000, then that means this is already a 0.1 lot size. But if I increase it again to 100,000, then that means this is a one standard lot or a one lot size. Okay, so that's the meaning of units and standard lot size. Okay, so here we got some examples. So for example, 3 traders bought a currency pair with a standard mini and micro lot. So with a 20 pip move in profit, so this will be their respective rewards. So for example, for one standard lot, which goes up to 20 pips, it will give you $200. Okay, because times 10. Again, for every one lot size, it will give you $10 per pips. $10 per pips. So that's why it will give you 200 if the price goes up to 20 pips. Okay, and then if you open 0.1 lot size, So for every 0.1, it will give you $1. And then for every 0.01 lot size, or for every micro lot size, it will give you 10 cents. Okay, so that's why if the price goes up to 20 times 1, it will give you $20. If the price goes up to, or again, if the price goes up to 20 times 0.1, it will give you $2. Okay? So now we are going to talk about leverage. So this is having the ability to control a large amount of money. So this is what I am saying earlier, using none or very little of your own money. So for example, you have $200 on your trading account, and then you use 1:1 leverage. So that means your buying power, so as we can see here, your buying power will just be times 1. So equals just 200, right? So it is like trading with just $200. But if you use 1:10 leverage, so you will multiply this now by 10. So you will now have the ability to trade $2,000, and then you can open a bigger lot size. So as you can see here, because you are only using 1:1 here, then you can only open a small amount of lot size. Okay? But as you can see here, if you use 1:500 leverage, then you will be able to trade times 500 of your 2,000. And because of that, you can open bigger lot size. Okay? So as we can see, using only 1:1, you can only open 1,000 units or 0.01 lot size. If you use 1:10, that will increase up to this one. So there, as we can see, this is the beauty of leverage. So if you have $200, just $200 on your account, and then you use 1:100 leverage, then multiplying this by 100, then that means you can trade with $20,000 of your account, right? So imagine having the ability to trade this big of amount, having the ability to trade $20,000 off of your $200, it will give you a boost, right, on your trading account, because you can then open a bigger lot size. So for example, you want to risk 3% per trade, then that will be very, very possible because of your leverage. If you want to risk 5% per trade, so imagine winning in a single trade with 5% risk on it, then it will already give you 5% return, right? But again, this is a double-edged sword, because for example, you lost this 5% trade, then that means you will already lose 5% of your $200. So that's why you need to choose the right amount of leverage depending on your account balance. Okay? So in OctaFX, you can open up to, I think, 1:500, if I'm not mistaken. Correct me if I'm wrong. But you can open up to 1:500 leverage using our platform. So imagine if you only have $100, you can multiply it by 500. And then you can risk any amount of your capital. So let's say you want to risk 10% per trade. So that means for every wins, it will give you $10, right? And you can also open bigger lot size because of high leverage. Okay, so just a tip: if you are trading with a smaller account, so let's say you only have $100, I may suggest to use only 0.1, 0.02, something like this. Okay, open only 0.03. Don't use one lot size, because this will cost you $10 per pip. So imagine losing losing $20 off of your 100, then you will already lose 20% of your account. Okay, so that's why it's very, very important to use the appropriate or the right lot size based on your account size. Okay, so to calculate on your lot size, so here we have some formula here. So to open your lot size, what you need to do is to divide your amount, the amount you're risking. So for example, you want to risk only $3 of your account. All you have to do is to divide it by stop loss. Stop loss multiplied by the value per pip. So this is 10, always 10. So stop loss. So what I'm trying to say here is, let's say you want to risk $3 for that specific trade. Then let's say your stop loss is 5. All you have to do is to multiply it by 10. So 3 divided by 5 times 10. Once you saw the answer, all you have to do then is to divide it by 100. So let's try doing this on a calculator. So let's say I want to risk only $3 on my account, and I just need to divide it by 5, then multiply it by 10, and then divide it by 100. So 0.6 will be my lot size. Okay, 0.06 I mean, because 0.06 will give me $0.6 or 6 cents. So multiplying this by 5, so this will be equal to 3. So if I lost the trade, I will only lose $3. Okay, so that's how we can calculate our position size using this formula. Okay, so moving on, we will now talk about take profit and stop loss, and this is very, very important for you to be able to be a consistent profitable trader. So take profit is an order sent to your broker to automatically close. So this is what I'm saying earlier. If your market, if the market that you are trading has a high liquidity, it will automatically close after reaching your take profit level. So this is the beauty of the Forex market. Okay, to an open position in your profit at your preferred price. Okay, take note, your preferred price. You don't need to fall in line first or to wait before your take profit will close. It will automatically close for you. And of course, for your stop loss, it is also an order sent to your broker to automatically close an open position at a loss. So for example, you are risking 1% per trade, then the price goes down, the price goes against you. If your stop loss was hit, then you will only lose 1%. But if the volatility or the liquidity is low, then the trade or the stop loss won't be executed right away. So it is very, very hard for us traders to deal with that, right? So why do we need this? So the most important job as a trader is to manage and preserve your trading capital. So always remember to play the long game. So only risk 1% per trade. So this is the golden rule in trading. So only risk 1% per trade, because it will take you 100 losing straight for you to wipe out your account. And this is very impossible, right? Losing 100 straight in a row is impossible. But if you are risking 10%, then with just 10 losing straight, you will already blow your account, right? So that's why if you are using a stop loss, of course, all traders must use a stop loss. I recommend only using 1% per trade. Okay, and then for your take profit level, you can use a 1.5 or twice your risk. So for example, you are risking 1%, then you can use 1.5% for your TP or 2% if you are more of an aggressive trader. Okay, so that's that's our session for today. So let me just do some example here. So for example, here on the trade that we opened earlier for the dollar Canada, so if you want to put a stop loss, so we all know that I bought this trade, or I bought this pair, and you can see that my open active trade is right here, right? So far I am down 65.96. So if I want to put my stop loss, so let's say I want to put my stop loss once the price breach the support. So that means I want to put my stop loss right here, right? So there's two ways in doing that. So the first one is to just drag your position. So this is your position, right? So just drag it right here, and then your stop loss will be automatically placed right here. And then for your TP, just do the same. Just drag your position to your preferred take profit level. So let's say we want to put it right here, and then the TP will automatically be placed right here. And then the second method, or the second way for us to do it, is to manually put it right here, just like what I showed you earlier. Okay, so let's do some brain tests. So put your answers on our comment box. So what do you think is the opposite of a trending market? So what do you think is the opposite of a trending market? So everyone is free to put their answers on our chat box. So I believe this question was asked last time. Which currency comes first in a currency pair? So if you remember, you can also put it on the chat box. Again, what do you think is the opposite of a trending market? So if the market is trending up, so we can see a move like this. If the market is going down, so we can see a move like this. So what do you think is the opposite of this move? So Jasmine Fabian commented ranging market. So how about the others? Do you think Jasmine is correct? Yes, base currency is the answer for this question. So this was asked last time. Jason Robles also said ranging market. Shailendra at 99 said sideways. So ranging market and sideways are the same. All right, so you are correct. So the opposite of trending market, of course, is just a ranging market or a sideways move. Okay, so for our next question, so how many units of a currency can you buy or sell with 3 standard lots? Again, so how many units of currency can you buy or sell with 3 standard lots? So if we have three lots, so what is the corresponding units of this lot size? Hello, home sweet home. So you can trade at least 1 to 2 times per day. In my experience, I am doing that. So what you can do is to, let's say, you want to risk 1% per day. So let's say, if you want to trade twice a day, then you can divide it by 2. Just open 2.5% per trade. Okay, so if you want to risk 2% per trade, then just open 1% for each of your trades. So again, for this question, how many units of a currency can you buy or sell with 3 standard lot size? So others are saying 30,000 while others are saying 300,000. So how about the others? Okay, so if you said 300,000, then you are correct. Because remember, for every one lot size, it has an equivalent of 100,000. Therefore, if you are opening 3 lot size, then it will be 300,000. Okay? And for our next question, so what is the trading power or the buying power of a 6,000 trading account with 1:100 leverage? Again, what is the buying power of a 6,000 trading account with a 1:100 leverage? So if you remember this one earlier, then you know how to compute this. If you have a buying power of $6,000, so if you have $6,000 on your trading account using 1:100 leverage, what will be your trading or your buying power? Again, using a 1:100 leverage. Again, if you have $6,000 on your trading account, and if you are using 1:100 leverage, what will be your trading power or your buying power? So Home Sweet Home and Shailendra at 99 said it will be 600,000. How about the others? All right, so if you said 600,000, then you are correct because all you have to do is to multiply this 6,000 to 100, to times 100. Therefore, it will be 600,000. So imagine you just have $6,000 on your trading account, but your buying power is 600,000. So in this case, you can use 1 lot, 2 lots, 3 lots, or maybe up to even 5 lots, right? Because you have a huge amount of your portfolio. Trading 600,000 or your trading power or your buying power is equivalent to 600,000. So that's why you can open a bigger lot size than usual. Okay? And for our last question, so do you think stop loss and take profit orders will work even if you are offline? True or false? So if you are online or if you are offline, do you think TP and SL or take profit and stop loss will work? True or false? Again, do you think take profit and stop loss orders will still work if you are offline? Yes, Lito Mateo, 1 to 2 trades per day is possible. Of course, you need to have your trading bias or your strategy before opening a trade, right? So if you don't have any setup for that day, then just don't open a trade. So based on my experience, I experience not trading for 2 days straight, for 3 days straight. But if there's an opportunity, then don't hesitate. Just manage your risk. All right. So to answer this one, the answer is true. Okay. So if you put your, so let's say you bought here, then you put your TP and your SL here, and then you goes offline. Of course, your TP and SL will still work. Okay. So for example, so in this trade, we have our open trade right on the dollar Canada. Then we put our stop loss here, and then we put our take profit here. If I close my platform, that SL and TP orders will still work. Okay, even if I turn off my computer. Okay, so for the promo code, it is PaulJM100. So for those who are not opening an account yet with us, so you may use PaulJM100 to enjoy the times 2 deposit bonus. Okay, and note that this promo code is only valid until May 31. Yes, Nola Nadores is right. It will be safe. Hello, Shailendra at 99. So the winner will be announced on our Telegram channel. All right. So again, the promo code until May 31 is PaulJM100 for you to be able to enjoy the 100% deposit bonus. Okay. So having said that, we can now go on to our Q&A session. So if you have any questions, so you can put it on our live chat box. Is it based on your experience trade Mona? TPNSL didn't work? Hello, Shailendra. You can join for each and every session. So if you win 2 times, then good for you. If you win 4 times, then very, very good for you. Hello, Sir Lito Mateo. So you can avail the promo just by using the promo code, which is PaulJM100. Hello, Home Sweet Homes. We are very, very glad to help you in your trading journey. So may I ask what is your favorite webinar so far? Is it the Fibonacci retracement? Is it the support and resistance zones? You are very, very much welcome. Yes, home sweet home, just participate on the task that will be given later. So the 1, 2, 3 pattern, I guess. We are also looking forward to have you next time, Sir Nolan Adores. Hello, God's times. The I believe the perfect strategy for beginners is the 1, 2, 3 pattern that we discussed last time. Hello, Jasmine Fabian. The Telegram channel can be seen at the description box. It is on the description box. I mean the link for the Telegram channel. Hello, Papu Boy. So the significance or the importance of candle wick rejection in your trading is very, very important. So let's say, for example, you saw this previous support that may turn into resistance. So once the price pulled back into it, so as we can see here, after breaking this support level, the price goes back or pulled back into it. And then as we can see, we have some rejections into this previous support, which is now turning into resistance, right? So we can see that the price is creating some rejections right here. So this is what we can call a candlestick rejection. So as you can see here, the candlestick is creating some wicks, right? Some wicks into right into this resistance level. So other traders, once if a trader saw that wick the wick is forming right into this resistance, they are instantly taking a trade, in this case a sell trade, into this resistance. If we go right, we can also see that we have some rejections right here, right? So we have one here. We also have another one right here. So as you can see, this is a very good example. So after rejecting the resistance, we can see that the price immediately goes down, right? So this is the significance of wicks. Once you are seeing that the wicks are forming right into the resistance levels, then that means there are some participants or there are sellers into this resistance level. So this is a very, very good strategy if you want to trade pullbacks. Hello, Sir Nolan Nadores. So you may look for our previous webinars. So there we talk about chart patterns. So just like Home Sweet Home, he said that before watching our webinars, he is constantly losing his portfolio, right? But after watching the webinars, he became consistently profitable. And he is using the 1, 2, 3 patterns that we discussed on our previous webinars. So you can see the playlist on our YouTube channel if you want to watch the previous webinars. Hello, Trade Mona. I am using 20 EMA. And I am also incorporating 50 MA on my trade. So sometimes I am only using one, which is 20 MA because I am a scalper. So for example, this is a 5-minute chart. So this is the ideal time frame for a scalper like me. So for example, I saw that the price is pulling back into this Fibonacci zone. So we can see that we have a Fibonacci zone right here, which is the 61.8 Fibonacci level. And then as you can see, this 61.8 is lining up with the 50 MA, right? So this is the indicator that I've been using for the last 6 years of my trading, because EMA is also acting as a dynamic support and resistance, just like here. So we can see that the price pulled back into this 20 EMA, and we saw that it is forming a weak rejection, right? So in this case, you can put a buy order here, or you can execute a buy order here. As we can see, the price goes up, but it failed to break this previous high right here. But in this case, we can see that if we put our TP from the previous high, then we will win with this trade. So this is the indicator that I've been using. But most of the times, I am only trading naked charts, or I am only basing on the price action alone, because indicators are lagging, or they are only following what the price action is telling us. You are very, very much welcome, Papu Boy. Hello, Pankaj Singh. I will communicate with the team later about that. But I guess on the previous task, I think there's already a winner. So we will just announce it inside our Telegram channel. So watch out for that. Okay, so if you don't have any questions, so I am inviting you once again to please join us on our next webinar, where we are going to discuss the types of analysis of the Forex market, such as fundamentals, technical analysis, market trends, and chart patterns. So for those who are asking, this is a very good topic for us, chart patterns. So we are going to discuss the patterns that Home Sweet Home has been using since watching our webinars. Okay, so you don't want to miss this webinar. So this will be on next Wednesday. Okay, so once again, this is Paul Mendoza, your trading speaker. See you again on next Wednesday for our next live trading webinar. Bye!